Okay, so as we can see here, let's go ahead and take a look here. So again, we're doing the chapter 9 and chapter 10 review. So let's get started with chapter 9. Right. So here for question number 1, we have here's a scenario that on January 1st, you opened your store and needed a petty cash fund, okay, for emergency expenses. Okay. All right, and then of course you establish you establish it to be $500 and should be enough for the first month. Okay, so let's go ahead and record this transaction, or how do we journalize to establish a petty cash fund? So here we know it's January 1st. All right, so go ahead.
You're gonna debit petty cash for 500, and then credit checking for 500.
Good, right? In this case, right, we need to dump money from our checking account, okay? So, and we're going to dump it in for the amount that we stated to be for the full $500. Perfect. Okay. And of course, you can make a note here that you are to establish right? I think that's Nathan. Yep. Hello. Oh, okay. So good. When we want to establish, you always want to use petty cash. So then question number 2 says at the end of the month, okay, you've counted all of the receipts in the petty cash drawer, all right? And of course, you had a total of $40.03 in cash remaining. So let's replenish this petty cash drawer. Okay, so here is a miniature petty cash ledger, right? That gave you a list of the dates and who took the money out, what did they take the money out for, and what was the exact change that they brought back with the receipt. So in this case, how do we actually replenish a petty cash fund?
You have to assign accounts to those expenses, correct? Or separate?
Correct.
Yeah. I was confused on this one. Where would you put the owner withdrawal? Would that be a business expense?
In this case, right, he took money out of the petty cash drawer. And in this case, it would be just an owner's withdrawal.
Okay.
Okay, so how are we going to replenish this petty cash drawer?
You have to journalize the description of each account, correct?
Yes. So let's go ahead and take a look at our first expense that we have here.
So you have 2 office supplies expenses.
2 office supplies expenses. Okay, good. So I can just highlight them here so we can keep track of them. So we got one right there, and we have one right here. Okay. So the first one, what was the total amount?
2680.
2680. Okay, so 1985 plus $6.95 for office supplies expense. Okay, so what 19 1985, or in this case, I'm going to, since I have Excel, I'm just going to go ahead and cell reference this. Okay. Good. What's the next expense that you see here?
Is that the business expense?
Business expense, okay. How many do we have? We have 3 of them, right? So 1,
2, right there, and then the one at the bottom.
okay. So we have business expense. Okay. And we're going to add up all 3 numbers. Okay, so we have this one plus this business expense plus this business expense. So what's my total amount of business expenses?
I got 107.28.
107.28. Good. All right. What's the next expense we're going to be listing out here?
Meal expense.
Okay, so we got 2 right here. Meals expense. All right. Okay, so we have 1 for 35.22 plus 1 for 15.67. So how much is that?
$50.89.
$50.89. Good. All right. Now, what's the next expense that we see here?
And you got delivery expense, 1, 2, 3.
Okay, so we have delivery expenses 1, 2, and 3. Okay, so delivery expense. Okay, so let's go ahead and add up all 3 numbers here. So we have 1 for $25. We have another one for $100. And we have another one for $50. So what's my total delivery expenses?
Ooh.
$175.
175, okay? All right, what else is on here? What's another expense here?
Advertising.
Advertising. All right, how much is advertising?
50.
For $50. Okay. And last but not least, what is the last thing that happened here?
That's the owner's withdrawal, and you always gonna put that as separate, correct?
Not in this case, I'm just replenishing the petty cash drawer. So in this case, it's going to still be considered something that you need to journalize. You don't need to separate for any reason. But if you mean by separate, yes, you need to separate in a specific account.
Okay.
So in this case, it's going to be an owner's withdrawal. Okay. And how much did the owner withdraw?
50.
He withdrew 50. Okay. So in this case, how do I replenish this? Now that I have all of my expenses here, how do I replenish this?
Checking.
Yes, we're gonna have to rewrite another check, or we need to take all of these receipts and convert them into cash. So we need to write a check out to the petty cash drawer to go ahead and reimburse or replenish the petty cash drawer. So right now, how much in total receipts do I have in my petty cash drawer?
For 59.97.
$459.97. So here, right, I was asking what was the total amount of receipts that we have in my petty cash drawer. And it's pretty simple, right? You're just going to count the total number of receipts that you have to get $459.97, right? Plus, we have $40.03 worth of cash left remaining in our petty cash drawer. So in this case, right, how much is going to be my total check?
For 59.97.
$459.97, right? And then I'm going to go ahead and write here to replenish petty cash drawer. All right. Pretty simple for petty cash. All right. Any questions here?
So what was the question? I'm sorry, I came late.
No worries. So we're just practicing chapter 9 and chapter 10. The question was, how do you replenish your petty cash drawer? All right, and the answer here is that you list out all of your expenses or all of the receipts, and you're going to convert them into cash by writing them out another check to put money back into the petty cash drawer. And you would do that by counting the number of receipts and then writing a check for the exact amount. And then placing this $459.97 in cash into the petty cash drawer. So then your petty cash drawer should always remain at $500. Okay. All right, so question number 3 says that on June 1st, okay, your business began to pick up, and the last few months that you were running low in the petty cash drawer, okay? So in the petty cash drawer, you decided that you need to increase the amount by $300, okay? So in this case, how are we going to record an increase in my petty cash drawer?
Okay. You're gonna put the date, then you're gonna put petty cash. Um, petty cash. How much you said? 300.
Mm-hmm.
Petty cash 300 and checking 300. And then you're gonna make a note at the bottom to establish petty cash fund.
So in this case, we're not establishing. What are we doing?
Oh, I'm sorry. Re-upping. Increasing. You're
Correct.
increasing the petty cash fund.
Good. So here we are increasing. Right? Because right now, how much money do I have in my right now? How much money did I have in my petty cash fund?
You have 500, right?
Mm-hmm. And now that I'm increasing it by 300, how much should I now have?
800?
You should have now 800, correct. Okay, so that's how we increase our petty cash fund, is that if $500 is not enough, we just add however much we need that seems to be reasonable. Okay? And we do that by journalizing the petty cash fund, okay? So never ever when we are trying to use the petty cash fund will we ever use petty cash, because in this case, right, our goal is to keep the total amount of receipts the same amount as what you establish your petty cash fund for, right? That's money that you need to, that's your budget, okay? So good. All right. So then here, question number 4, at the end of the year, you decided that you need to get rid of the petty cash drawer, okay? And you're going to be using a business credit card, okay, for all minor expenses, okay? So how do we record closing out the petty cash drawer?
You're gonna debit checking for 800 and credit petty cash for 800.
Exactly, right? You're going to take all the money from the petty cash drawer and you're going to place it all right back into your bank account, right? No pocketing anything here, right? You need to put it back into your checking account. And of course, I'm going to say to close out petty cash. Okay? All right? And that is all I'm going to be testing you on. How to establish it, how to replenish it, and how to close it. Any questions?
No.
Okay. All right, so questions 5 through 10 are going to be related to each other, okay? So this is going to be chapter 10. So let's take a look at the scenario here. So I have a few scenarios and questions here, and we have a journal for you guys to journalize, okay? So let's start with the very first one, okay? Number 5, on June 15, customer A decides to purchase a total of 100 toys for $5 each on an account, okay? And of course, sales tax is 8.25%. Record this transaction. So let's go ahead and record this one. So number 5. See, the date is June 15. Okay, so how do we record that customer A decides to purchase $100 toys at $5 each on an account?
This section is related to the allowance method, right?
Correct.
So we will debit accounts receivable for 541.25.
Okay. We'll hold on to that number. So 541.25.
Okay, and then sales and sales tax credit
Okay, so sales.
for 500. Sales tax for 41.25.
Okay, so in this case, right, 100 toys at $5. So 100 times 5 gives you $500. Tax is going to be based off of the $500 dollars that you sold. So in this case, right, this times 0. I think it's going to be 0.0825. Okay, to give you $41.25, to give you a grand total on accounts receivable, right? This is what the customer owes you, is $541.25. And what I'm going to make a note here is that I sold 100 toys to customer A. right? You don't need to mention that it's on an account because accounts receivable kind of gives you the idea that you place it on an account, okay? In this case, we're just focusing on just understanding how the allowance method works, so no discounts or anything terms are coming into play here, okay? So here on June 15, customer A decides to buy 100 toys. Right. Good. All right. So then number 6 says that on July 15th, you received a payment check of $50 from customer A. How do we record this payment?
Gonna debit. Was it cash?
So in this case, let's see what it says here. It just says, how did we actually receive this?
Oh, accounts receivable. My goodness.
Yes. What? But how did we receive the money?
Check, which is the same as cash.
Yes and no.
Oh, you would debit checking then.
Correct, because in this case, it's not in cash, and we would have to deposit to the checking account anyway. So yes, in this case, we're gonna treat checking or the check as if you're gonna be going to the bank and depositing into the bank. So in this case, it will go straight to checking, right? And of course, like you've mentioned before, it is going to be taken out from accounts receivable because we received a payment. How much was the payment for?
$50.
$50. Okay? And then I'm going to go ahead and make a note saying that I received payment from customer A. Okay. She only paid $50. Okay. All right. So then number 7, okay, on August 15, customer A refuses to pay for the remaining amount that she owes. So how are we going to record this? Okay. So customer A is refusing to pay for the remaining amount. Okay. When a customer refuses to pay, right, we can consider that as potential bad debt because that's potential money that we could possibly lose in the future. So what account are we going to be using to reflect that we need to reflect how much she owes us and how much is going to be potential bad debt? So how are we going to calculate this?
That will fall under allowance for a doubtful account.
Correct. And how are you going to journalize it? So it's August 15 now. How are you going to journalize that?
Allowance for doubtful account debit for 9125 and accounts receivable credit for 9125.
And what are you going to credit? I did not hear what you said.
Accounts receivable.
Correct, right? We're going to be taking it directly out from the account receivable because this is potential debt, bad debt, right? Because the customer decides to refuse to pay us. Now, how did you get this $49?
The for 9125.
Mm-hmm.
Because that was the 541.25 minus the $50 payment that he had made.
Good, correct, right? This is what customer A owes me as of right now. They owe me $491.25. Okay? And in this case, right, you could write this as potential bad debt. You could say customer A's account receivable balance, right? Because it's pretty straightforward. I know for a fact that allowance for doubtful accounts is a contra account to accounts receivable, but it's also, it represents potential bad debt, meaning we might one day might not be able to collect this money. Okay. So good. All right, so let's see what happened on question number 8 here. So we contacted customer A, okay, to receive or retrieve the debt that she owes. Okay. On October 20th, we received a payment of $15, okay, from customer A. So how am I going to record this? After we found out that customer A says they're going to refuse to pay me, okay? We go after her, right? You know, sending her letters and stuff, charging her late fees or whatever it is. In this case, we're not charging anything. But now that we finally contacted customer A, they said, here's $15. Okay? So how am I going to record this transaction?
So the account would be the allowance for doubtful account, right?
So in this case,
Yeah,
explain why would you use the allowance for doubtful accounts?
because we already record, it's no longer account receivable.
So what are we doing here?
Check and debit check for $15. I would say allowance for doubtful for $15.
Okay, so in this case, right, that's half right.
Half right?
Mm-hmm. So in this case, where is my money? Where is the money that she owes me?
Didn't you remove the account from your account?
Exactly. If I removed it, how do I reactivate her account? If I moved her money and place her account on deactivated or potential bad debt, how do I reactivate that now?
So that debt account, right?
Not the bad debt account. We haven't reached the end of the accounting period yet. Okay. So right now, I'm pretending that customers A's account is deactivated.
You have to activate it again. Like
Correct.
your accounts receivable.
Create. Good. Okay. And how would I do that?
With the accounts receivable for 9125 and accounts for doubtful account credit for 9125.
Exactly. So in this case, we have to reverse the account because in this context, right? I think I'm gonna do allow because I know. Because in this context, right? I've already said it's potential bad debt. I have to reactivate it or say now that I'm receiving a payment from them, I have to reactivate it, make it active again because then she could potentially pay for the whole entire amount. So I have to reactivate her accounts receivable account by undoing the transaction here. So I am going to be crediting the allowance for doubtful accounts for the amount that she owes me, right? Which is for the $491.25. Now, right, I can now receive the check for $15. And because I received a check for $15, it's going to now reduce the amount that customer A owes me. So in this case, it's going to reduce accounts receivable. Okay? So this is what happens when you saw a potential threat or a potential bad debt. You're going to place it in its placeholder, all right? Because it's in its placeholder, think of it like the account is on hold or it's pending on a transaction, right? So because you're placing it in a placeholder, you need to undo it or reactivate it if you see that this person is paying you back or giving you the money after it's been X amount of days, okay, or X amount of months, okay? So in this case, I recorded it on October 20th, right? Because on August 17th, right, refused to pay. September 17th, refused to pay. October 17th, they refused to pay. Except for October 20th, they decided to just finally go ahead and give you some money back. Okay? So in this case, we're exhausting as much as we can to try to collect our money. All right? And then, of course, I'm going to make a note that receive payment from customer A. All right. All right, so let's go ahead and see what happened on for question number 9. On November 28th, okay, debt collector informs you that customer A has filed for bankruptcy, okay, and that they can no longer pay you back. So in this case, file for bankruptcy, right? That's more likely that they're never going to pay you back. More likely, okay? It's still potential, but most likely they're not going to pay you back. The debt collector is not even going to pay you back either, okay? So in this case, right, they just filed for basically a loss and they're just letting out who this person owes on what account that they can no longer pay. So in this case, right, now that I know for sure that customer A no longer can pay me back, how do I record this transaction? Okay. And I'm going to add a couple more lines here. How do I record that on November 28th that now customer A can no longer pay?
So you gotta get that account out of your books again and do what Nathan said. The same thing with the allowance for doubtful accounts.
Correct, because in this case, once again, that's why keeping track of your customers, it can be difficult because you have to sometimes they'll make you go around in circles. They'll say, no, I can't pay. Here's some money. Okay, I can't pay. And they're going to keep coming after you, right? Because your main goal is that you sold something to them. And because they placed it on an account, you want your money back. You never want to have your products be sold and you receive absolutely no money. Therefore, you're not going to be profitable because you have bills to pay as well. So in this case, yes, you're going to now recognize that this is going to be an allowance for doubtful accounts. And once again, we're going to be taking this out from accounts receivable. All right. So in this case, how much does customer A owe me now?
The $491 minus the $15.
Correct. Gives me how much?
I don't have a calculator with me right now.
$476.25.
$476.25. Right? Good. Okay. And I'm also going to go ahead and record that customer A, this is customer A's accounts receivable balance. Okay. Now, a lot of people have a lot of questions in regards to this. Okay, so, well, what happens to the sales tax and what happens to the actual amount that you sold? In this context, right, I'm getting rid of $476.25, right? However, which way that you deem necessary that you received or what you have calculated, most oftentimes the best way that you would be able to do this is that you would split it, like what portions of the money that you actually collect for the sales and what portion of the money you actually collected for sales tax. But for most cases, if you're writing off a loss, this is money that you never received. So this is also tax you never received, right? Because this is including the tax as well, okay? Once again, I'm not going to go super into detail for that just because that's not what we're focusing on. We're focused on what happens when you see potential bad debt. What do you do with it, okay? So once again, this amount right here includes the sales tax that you never have collected. So you're not responsible for it because in this case, we're going to revoke or we're going to undo this transaction as if this transaction has never happened. Right? And that's exactly what we're doing right here. Right? This person we never made a sale to this customer, right? So in this case, we're writing it off. All right.
Good. That was my question. Yes.
Okay. All right. Last but not least, question number 10 says that as of December 31st, our company estimates that $2,556 out of our $200,000 accounts receivables are to be uncollectible. And there's currently a debit balance of $476.25 in the allowance for doubtful accounts. How are we going to record this allowance? Okay. All right. So let's look at this carefully, okay? It is now December 31st, okay? So it's the end of our accounting period, okay? And we have an estimated amount of $2,556. Okay? And it's an estimated amount based on accounts receivable. Okay? So in this case, how are we going to journalize this?
We're going to debit bad debt expense and credit accounts for doubtful account.
Excellent, right? So in this case, we reach the end of our given accounting period. So therefore, we are making an adjustment, right? And the adjustment is that we're going to write off whatever amount to be considered bad debt. Okay, so this is for sure that we are making a conclusion that we are not going to be receiving this money. So in this case, right, we are going to be creating a bad debt expense account to write off the loss that we've incurred. And we are taking it out from our allowance for doubtful accounts. Okay?
Is that considered a contra account?
The allowance for doubtful accounts is a contra account to accounts receivable. Bad debt expense is going to be an adjustment entry. It's a regular expense account. Okay. Now, how do we solve for that amount that we need to write off? Okay, in this case, which allowance method am I going to be using?
Add.
Okay, good. Add, right? Which is going to be the balance sheet method, right? Because we see the accounts receivable, right? We're not using the income statement method. So because we recognize that there is a debit in my allowance for doubtful accounts, we're going to be adding them together. So excellent. So in this case, right, I'm going to be adding my estimated amount of $2,556 with my debit amount of $476.25. So how much is going to be my grand total that I'm going to be writing off?
3,032.25.
Okay, good. 30, 32, 25. All right, and there's the allowance for doubtful accounts. So this is going to be to write off bad debt. Okay. Any questions here? So this is how, when we're dealing with the customer during the period, right? And that's how we have a debit or credit balance in the allowance for doubtful accounts. As we progress through this line, as we see, right, we started from June. We made our transaction, right? We placed it on an account. We realized that the person's making their payment, so that's what we have to record. And we notice that the customer starts falling off the trails and says, I can't pay. So this is how we create an allowance for doubtful accounts and create a balance for them. And then once we reach the end of the period, the accounting period, then we realize, well, realistically, because we allow our customers to owe us on an account, we have to be subject to have potential risk that we won't be able to collect it. And that's what we have to do at the end of the year. IRS allows companies to take a loss because of the idea of us allowing our customers to owe us money. And we have to assume the risk that not all the customers are going to pay us back 100%. All right? Any questions here? Okay. Okay, so let's go ahead and practice that bad debt accounts. Okay, so here you go. So this is what's going to be on the exam, and this is the only thing I'm going to be testing you on is, do you know how to use the allowance method? All right. So in this case, number 11, okay, on December 31st, your company estimates that $2,430 of its $500,000 total credit sales are to be uncollectible. And there is currently a debit balance of $1,500 in the allowance or doubtful accounts. Journalize this transaction.
You're gonna debit bad debt expense for $2,430.
Okay, for $2,430. How did you get that number?
I just used the company's estimate.
Good. And what made you just only use the company's estimate?
Because we're talking about credit sales and accounts receivables not involved.
Perfect. Excellent. So we're using the income statement method, right? Where we don't care what is in the balance in our allowance for doubtful accounts because it doesn't appear on that worksheet. So therefore, that is correct. And what account are we going to be taking it out from?
Allowance for doubtful accounts for the same amount.
Excellent. Allowance for doubtful accounts. Excellent. Okay. So then same scenario except this time. Question 12 says that on December 31st, Your company estimates that $2,430 out of its 500,000 accounts receivables are to be uncollectible. There is currently a debit balance of $1,500 in the allowance for doubtful accounts. How am I going to record this now?
You're going to use the balance sheet method.
Mm-hmm.
Debiting bad debt expense and crediting allowance for doubtful accounts.
Okay. And this time, how much is going to be my debits here?
Since there's a debit balance, you're going to add the estimate and the balance, the debit balance rather.
Good.
So it'll be 3,930.
Excellent. Okay. Because on the balance sheet, we recognize that accounts receivable exist on the balance sheet. So does the allowance or doubtful account. So in this case, we do care about what the balance is, and because there's a debit, and our end goal is to try to get to 2,430 on the credit side, we need to add it because we're on the left already. We need to get all the way onto the right side. So in this case, you're going to add those two numbers together. Okay. Good. All right, question number 13. Okay, on December 31st, your company estimates that $2,430 of its 100,000 accounts receivable is to be uncollectible. There is currently a credit balance of $1,500 in the allowance for doubtful accounts. How are we going to record this adjustment this time?
Bad debt expense for 930 and allowance for doubtful accounts for the same amount.
For how much?
I got 930.
930. So, let me see. We're going to take my 2,430 because that's my estimated amount, right? I currently have a credit balance. So that tells me I must subtract from that account to give me $930. Is that what you said? 930?
Yes.
Perfect. 930 because in this case, I'm already on the left side. How much do I need more to get to a total of $2,430? So that's where we get $930 because you're already on the credit side. Okay? You already have potential bad debt that's already taken out. So in this case, I only have 930 more left to go to get to 2,430. Okay? Last but not least, question number 14, December 31st, your company estimates that $2,430 out of its $500,000 total credit sales, right, is to be uncollectible. There is currently a credit balance of $1,500, okay, in the allowance for doubtful accounts. Now, how am I going to record this adjustment? Okay.
So bad debt expense for 1,500.
Not 1,500.
Is it the 930?
Not 930, no.
Hmm.
Let's take a look at this, okay?
No, I'm sorry about that. It's 2,400 there.
Perfect, right? In this case, right, which method am I using?
Income statement.
Income statement, right? So in this case, total credit sales is going to be on the income statement, right? So do we care about what our a balance is in our allowance or doubtful accounts?
No.
No, it doesn't show up. It doesn't appear on on my income statement. So in this case, I don't care if there's a balance. I don't care if it's a debit or a credit balance. In this case, I only care about what my total estimated amount was. And in this case, it's only 2,430, and that is correct. It's just the estimated amount, okay? So this one, once again, I tested you on all four ways to interpret this. Make sure that you read carefully because that's how you're going to be able to differentiate between the two different methods, okay? So I gave you four examples. One with the accounts receivable with both a debit and a credit balance. And I also gave you a total credit sales with both a debit and credit. And in this case, for my total credit sales, I didn't care about my debit or credit. Okay. Whereas the accounts receivables, I do care about my debits and credits. Okay. Any questions here?
Not a question, but I would like to share with my classmates a tip that I learned from your videos.
Mm-hmm.
Every time you see total credit, it refers to income statement, and every time you see accounts receivable, it refers to balance sheet.
Yes, that is correct. Okay.
So
Oh,
repeat that. Okay, so total credit, it means what?
in,
Um,
income statement.
Income statement.
Income
That means,
statement.
yeah, that means you're just gonna use the company estimate. And when you see accounts receivable, then that's when you're gonna be using the balance sheet, which means if you have a debit, you're gonna add that amount to your company estimate, and if you have a credit, you're going to subtract.
Cool.
Is that
Thanks,
correct, Miss?
Erica.
That is
You're welcome.
correct. That is correct.
Thanks, Erica.
Okay.
Welcome.
All right. So there you go. Right. So question 15. Here, I believe we're going to be practicing our simple interest. Okay. So do you guys remember what the simple interest formula is? How do you solve for interest under the simple interest method or a simple interest calculation formula?
It's
Simple.
principal times rate times time.
Principal times rate times time. Okay, excellent. All right. What's my future value going to be?
Principal plus interest.
Principal plus interest. Okay. All right. So let's go ahead and practice this real quick. All right. For my very first one, my principal is going to be 28,000. My rate is 4.35%. And my time is going to be 150 days. So how are we going to calculate this? So in this case, why is my time in terms of days? how would we convert this to make it in terms of years? Okay. How many days are in 1 month?
30.
Equals 30 days. Okay. How many months are in a year?
12.
Okay. So with this concept, right, it's the same thing here. We're going to apply it to this, okay? So in this case, how many months is 150 days?
5.
It's going to be 5 months, right? But because I want it in terms of years, okay, if I want it in terms of years, what is 5 divided by 12?
0.41666.
Okay, so, right, 0.4166667, right? That's how much for one whole year. Is only 40%, right? Because I'm only doing 5 months. So in this context, right, how are we going to solve for the interest if I'm only doing 5 months? Or in this case, yeah, I'm not doing a whole year. I'm only doing 5 months out of the year, 40% of the year. So in this case, right, I'm going to go ahead. I'm going to use equal round because I want my interest number to be to the nearest penny. All right, I'm going to enter in my formula just exactly as is. All right, now there's 2 ways that you can do it. I would recommend you to use fractions, okay, just so then you can get your decimal point to be the most accurate. So in this case, what I'm going to do is I'm going to take my principal of 28,000. I'm going to multiply it by my 0.0435 because that's my percentage in decimals, right? It's 0.0435. And I'm going to multiply this by 5 months, but divide the whole thing by 12 because I'm only focusing on 5 out of the 12 months. All right? Comma 2. And what should I get to be for my interest?
I got 507.50.
$507.50. Okay. So once again, we're looking in terms of how much money, how much interest we're going to be collecting based off of only a certain section of a year. Only 5 months worth. So in this case, I'm earning only $507.50, okay, on a $28,000 principal. Okay? Not bad.
So how did you come up with the 507.50?
Okay, so what we did was we did principal times rate times time because this is simple interest, right? That's our standard formula to figure out how much interest is. However, the rate is in terms of years. The time is not. We're only doing 150 days, which is equivalent to 5 months. I can't calculate for the whole year because I'm only looking at 5 months out of a whole year. So you need to calculate how much 5 months out of 12 is, which is to tell you how much percentage of a whole year that you're going to be collecting interest on.
So you wouldn't use the 4.35%?
You are using the 4.35%.
Okay, so you use that times the principal?
times the principal.
No, times the time. I'm not getting it. Okay, so you have your principal, then you
Correct.
have your rate of 4.35, and then you
Correct.
have 150 days, which totals 5 months out of the year. So you would multiply the 4.35% into your principal and then
And
multiply it by your 150 days.
well, in this case, 150 days isn't in terms of years. I'm not calculating 4.35% interest on a whole year. I'm only
No,
doing 5 months out of a year.
right?
So I have to convert my time to reflect what it's going to look like in terms of years. In this case, I'm only doing 40% of a year, right? I'm not doing full 12 months. I'm only
Right.
doing 5 out of the 12 months.
Okay, so how did you come up with the total with your interest?
I calculated the principal times the rate times 5 out of 12 months.
And that is because the rate is an annual rate, correct? That's why you need
Correct.
32
Correct.
years.
Correct. Because this is an APR, it is an annual percentage rate. So in this case, we need to keep everything consistent. So that's why we would have to convert the time in terms of years. So in this case, instead of actually calculating it on the side, what 5 divided by 12 is, I went ahead and just placed it into the formula because in this case, order of operations, it doesn't matter here. Because at the end of the day, you're taking the total amount and you're dividing it all by 12 anyways.
Okay, I got it.
Okay? So you should get 507 and 50 cents. So therefore, what is going to be my total future value?
$28,507.50.
Good. Perfect. Okay. All right. So let's go ahead and let's do the second one now. Now the second one, it's in terms of years, 10 years, right? 6%, and this time it's $5,147.50. So in this case, right, my formula is going to be my principal of $5,147.50. I'm going to multiply it by my rate of 0.06, and I'm going to multiply it by 10 years. So in this case, how much is my interest that I will be collecting in 10 years?
$308.85.
$3,088.50. Right? Good. All right. So therefore, what is going to be my total future value?
8,236.
Okay, good. And let's go ahead and do the last one.
I have a question here.
Mm-hmm.
On the last question, can we use the normal calculator to get the 8 out of 12, or we have to have Excel?
You can do, yes, you could do it on a regular calculator, yes.
So the principal times 0.0349 times 8 divided by 12, that brings you the answer, or?
Yes, you could do 8 out of 12. It should give you the same exact answer. You don't have to do 8 divided by 12 to get that answer first and then apply it into here, into the formula.
Okay, first get it out. Okay, got you.
Okay, so sorry, what was that again? So how did you do this one? So we take our principal, we multiply it by 0.0349, and we're going to multiply it by,
Someone is speaking? I can't hear anybody.
no one's speaking.
Okay. I got 15,917.89.
Oops, I forgot the ending argument, comma 2. Good. 15,917.89. Good.
Wait. So how did you get that, Nathan? You multiply the 684,150, and you multiplied it by the rate.
The rate, yeah, 0.0349.
0.034. Okay.
And then eight months out of 12, which is,
Okay. All right.
but first I did 8 divided by 12, just trying to get rid of that uh, fraction.
Okay, because like you can, if you wanted to, that's the same thing too. If you want to find out what the fraction is, you can do that. But if you are using a calculator, you might round yourself a little too early. Okay, so but
Oh, okay. That's why I didn't get the same number because
yes,
it rounded too early.
yes. So and that's why I do recommend if you're going to be doing it that way, right? Best recommendation is just if you see this, just convert it in terms of months. So 8 months, right? Divide the whole thing by 12 and you'll get the same answer without
Oh,
running
okay.
into that error. Yeah.
All right.
So the
Okay.
future is 700,067.87.
Good. 7,067.89. Okay. So once again, I'm only gonna be testing you on simple interest, okay? Just because, once again, I can't expect everybody knows how to use Excel, okay? So simple interest is all you're gonna be needing to know for the exam. Okay. All right, let's go ahead and do the very last one before we go on break, which is our bank reconciliation. Okay. So once again, on Orbund, as you know, there's not that much space for us to be able to put in like an actual table or like an actual statement or anything like that. So this is as simple and simple as I can create the actual worksheet itself. Okay, so here is what it's going to see. You're going to see a bank statement. It's going to give you all the information that you need to complete the bank reconciliation, right? Then you're going to have a cash ledger, which once again, or a check ledger, which once again is going to give you exactly the detailing on what is going to be in your cash ledger at all times, okay? And once again, you have your table here. So, like we've done before, we have to compute the bank reconciliation. So first thing we got to do is we have to recognize what the ending balance is on each statement.
Can you remind me again on what lesson video? Because I don't recall.
This is 10.3. 10.3. Mm-hmm.
Gotta go back and watch that. Will your ending balance be the bank statement balance?
Okay, so if we're dealing with the bank side, yes, we're going to be dealing with the ending balance on my bank statement. So let's take a look at my bank statement. What is my ending balance that appears on my bank statement?
850.
850. Okay? So if you guys remember the rules, right? For the bank doesn't know what I deposited nor how many checks I've written out. So in this context, right, we got to remember our dues for the bank. So dues is deposits in transit and outstanding checks. So in this case, right, let's take a look at comparing my cash ledger to what appeared on my bank statement. Okay. So here on my cash ledger, or my check ledger in this case, right, checking, this will be checking, I have deposit number 44, 45, 46, and 47. Now let's take a look at my bank statement. Which deposits actually cleared?
Only 44 and 45.
Only 44 and 45. So in this case, I'm missing two deposits that I've deposited, but the bank hasn't recognized it yet. So in this case, I need to add back my deposits, or I need to add the deposits in my bank, because the next day or the couple days after, it should clear in my bank account. So in this case, right, I have deposit number 46 and deposit number 47 that has not cleared. So in this case, right, what was my total deposits for number 46 and number 47?
300 and 450.
So the first one is for 300 and deposit 47 was for 450, okay? Because on my books, I said I should have that money already in my bank account. But the bank says no, it's still processing the money. Okay? So I need to add it to my bank account because it should appear in my bank account. Okay? Now, after I've done that, next section is outstanding checks. So in this case, in my books, right, on the cash on our side, right, we recognize that we wrote a total of 5 checks, right? We wrote check number 101, 102, 103, 104, and 105, right? Now let's go ahead and double confirm which checks actually cleared from my bank account, because we have two things that we have to wait for, right? One is maybe we sent out the check too late at the end of the month, So no one's it's still being sent to the person. And second thing is, in order for the money to be taken out from your bank account, the recipient person who's receiving the check needs to deposit it into their checking account. So in this case, we are also waiting for our vendors to go ahead and submit the check into their bank account. Same thing on their end too. It could also process anywhere from 2 to 3 days. So in this case, how many checks actually cleared out of the 5 I've written?
3.
Only 3. 101, 102, 103. So therefore, my check for number 104 is still pending, and my check for 105 is still pending. Okay, so $50 and $125. Okay, so check number 104, check number 105. Okay, and in this case, it is a negative $50 for check 104, and it's a negative $125 for my check number 105. Okay. So in this case, let's go ahead and solve for my adjusted balance amount, my ending balance. What should it be now? Okay. If I started in my bank account with 850, I'm adding 300 plus 450, subtracting 50 and 125. What should be my ending adjusted balance?
1,425.
1425. Okay, let's hold that in our bank account because that could be potentially not correct, right? Because the end goal is that our bank must match our cash ledger. Okay, so let's go ahead and take a look at our cash side now. First thing that we have to start off with is our ending balance. So let's take a look at our cash or check ledger. What is my total ending balance?
14K.
1410. Okay. Now, let's take a look. So, on our side, we don't know how much the bank has charged us or how much interest we've collected in the bank, right? We won't see that until we receive the bank statement. So, we need to now update our books to reflect that we've been charged this and we've been collecting interest. So, in this case, right, on the bank side, they've already automatically did it for us, right? If you write an NSF check, they automatically charge you right then and there. And they don't notify you unless you set up your notifications. But in this case, right? So we need to understand it that way. What does the bank know that we do not know? So in this case, we don't know how much interest we've collected, and nor do we know how much fees that they've charged me. So in this case, right, first thing I'm going to do is I'm going to recognize, well, how much interest did I collect? Now, of course, ACH and interest could be done in 2 ways, right? If you have accounts receivable that you have finance charges for, you're collecting interest off of that. And if they make a payment to you, you're collecting interest. All right? ACH is when you charge any convenience charges for electronic funds transfers. So, for example, right, you tell the bank, charge them a flat rate of $5 because they want to pay with a credit card or they want to pay with electronic funds transfer. You're charging them an additional convenience charge. So, in this case, right, I'm collecting money because it's collecting it through the bank. So in this case, interest, I've earned a total of $25. And for ACH, which stands for Auto Clearing House, I've earned a total of $175. Okay? So therefore, I have to add that to my account because that is money that I earned for for setting up my bank account, okay, for allowing to collect money using the bank account. Okay, so here I'm collecting $25 of interest, and I'm also collecting $175 worth of auto clearinghouse. Okay. Okay. So now I'm going to also subtract out my fees that I have to pay the bank for providing services, or in case they charged me for writing an NSF check. So let's take a look. What did the bank charge me?
$100.
They charged me service charges for $100. What else did they charge me?
50 for the non-sufficient funds and $35 for a return check fee.
Correct.
So $185
Good.
altogether.
All together, they charged me this, right? So I wrote an NSF fee, and because I wrote that check, they automatically charged me $50. They also charged me an additional $35 because that check bounced, meaning the bank didn't go ahead and push it forward and paid for me. It bounced. So the other company, or the vendor, decided to say, hey, your check bounced, so it reflected on my bank statement. Okay, so therefore $185. So here, less service charges of $100. Okay, I had an SF, and I think I had a return check fee. Okay, so here I have a negative $100 here. I got charged $50 for writing an NSF fee, and I got charged $35 for a bounced check. Okay. So in this case, what is going to be my total adjusted balance amount? So if I started with $14.10, added $200 for my interest and things I've collected, and subtracted $185. What is my adjusted ending balance?
1425.
$14.25. And guess what? We match on both ends. So therefore, we've completed our bank reconciliation correctly. No discrepancies here, no mistakes anywhere else, right? And that's exactly what I'm going to be testing you on. I'm only going to strictly ask you, what are your deposits and transits? What is your outstanding? What is your interest? And what is your fees? And that's it, right? Any questions for chapter 9 and 10 exercises, review exercises?
No.
Okay. All right. So what I'm going to have you guys do is I should stop this. So what I'm going to have you guys do is go ahead and go on break. Okay. It is 9:50, so go ahead and take a nice 20-minute break, and be back no later than 10:10, 10:11, since I'll give you an extra minute. Okay.